No, that's your third helping, young man. It's making you fat and soft and tender. You just cut in line, didn't you? Reported attention, Ooter.
For how long?
Oh, about 7 minutes a pound should do it.
Hey guys, Rafi from the Endgame Investor, and today I want to go into Deutsche Bank and 3 things about Deutsche Bank that could make it the next domino to fall. Well, Deutsche Bank is going to fall anyway because as a fractional reserve bank, as all banks are, it is inherently bankrupt. There are 3 factors about Deutsche Bank that could mean that its bankruptcy, its inherent bankruptcy as a modern Keynesian fractional reserve bank, will be revealed shortly. One is the additional tier capital, the AT1 capital on its books that has been hit by the erasure of $17.1 billion in AT1 capital from Credit Suisse when it was acquired by UBS. That debt was written off, which means that the AT1 capital on everyone's balance sheet gets devalued because now everyone knows that it is the first to go in a crisis. So we're going to look at how much AT1 capital Deutsche Bank actually has, how it hurts its capital position, and why capital positions don't really matter when people are taking deposits out of a bank trying to save their money. The banks have to have a specific ratio of capital to assets, because if their assets go south and go sour, the bank needs enough stuff that it can sell in a fire sale to give depositors their money. And it's not like if the bank is in a position to actually do this and it has enough capital, let's say, to cover all deposits, it's not like people are going to say, oh, whatever, well, I have money in the bank and they have enough tier 1 capital, so they'll just sell what they have to sell, and I'll be fine. I'll get my money out. No, everyone's going to run out of the bank at the same time because they're going to say, well, what if more depositors come in, or what if they run out of capital? What if the capital on their balance sheet isn't as valuable as they say it is? I really got to get my money out now because I'm not going to risk it based on some capital ratio that some regulator that couldn't see the 2008 financial crisis doesn't understand. Second, we're going to look at the commercial real estate loan portfolio of Deutsche Bank. It's not huge as it is in regional banks, which have most of this stuff on their balance sheets, but it is substantial. It's about $33 billion, and commercial real estate is floundering right now. And according to Goldman Sachs, it's going to be the next central issue of the current banking crisis. And third, we're going to look at its derivative portfolio of about $46 trillion and what happens if Deutsche Bank falls. What happens to those derivative positions? They are canceled out. And then what happens to the derivative market complex at that point? So first things first, let's talk about AT1 capital. So first of all, let's look at this, understanding capital adequacy ratio. What does that mean? What capital level is adequate? And what does it mean by capital? It means that if a bank is in trouble, stuff that it can sell really quickly to make sure that depositors won't freak out. So tier 1 capital is like really liquid stuff that supposedly it can sell, which is exactly, remember, what Silicon Valley Bank did when it saw a hole in its balance sheet. So it sold all of its tier 1 capital available for sale, which were treasuries, extremely liquid stuff. And it took a loss on that, but it raised like, what was it, $21 billion or something like that. And it still collapsed entirely. So, it doesn't really matter what somebody's capital ratio is. Capital adequacy ratio is if depositors freak out. They don't care about percentages and they don't care what regulators say because regulators are incompetent idiots.
I believe sucking smoke into your lungs will kill you.
My physicians say it relaxes the throat.
They're idiots.
They've all been knighted.
Makes it official then.
So understanding the CIR anyway, talking about idiocy, the capital adequacy ratio is calculated by dividing a bank's capital by its risk-weighted assets. Currently, the minimum ratio of capital to risk-weighted assets is 8% under Basel II and 10.5% under Basel III. Well, 10.5%. So it has to have 10.5% of its assets on the capital tier 1 level, so it can, let's say, reflate itself by a factor of about 10.5% in the event of an emergency. And so let's look at Deutsche Bank's tier 1 capital ratio. So we have here, this is page something of its annual report, 134. Look at that, 134. So you look at these numbers and they look really stupid and scary, and they are. And you have here tier 1 capital, T1 equals CET1 plus AT1. Who cares about these letters? Doesn't really matter, but the number here is 56.616 billion. That's the total amount of capital they have. And how much is the AT1 capital, the additional tier 1 capital? That was the stuff that was written off in the Credit Suisse move under UBS, and that stuff was just like written down to zero. It was $8.518 billion out of 56.6 billion of tier one capital. So that's about 15%. And what is the CAR ratio, the capital adequacy ratio of Deutsche Bank?
Drum roll, please.
CET1 capital ratio was 13.4% for 2022. 13.4%, but that was before AT1 bonds were wiped out. And one for Credit Suisse. So now that 15% of the Deutsche Bank CET1 capital is AT1, remember 5.8 billion or whatever it was, 8.5 billion out of 56 billion, that's about 15%. So 15% of its AT1, of its tier one capital, which was about 13.4%, is now wiped out. So that brings it down to like 10 or 11%. So what is the minimum according to Basel III? It was 10.5%. And so our depositors are going to be happy about this. Are they going to start a run? They haven't yet, but they might. And here is the second issue with Deutsche Bank. It has to do with the commercial mortgage-backed securities, commercial loan, commercial real estate portfolio. And what is that for Deutsche Bank? The commercial real estate focused portfolio is 33 billion. Included in the bank's loan portfolio is comprised of non-recourse CRE lending, blah, 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 blah. $33 billion worth of commercial real estate loans. Is that a huge number relative to its assets? No. But is it significant enough to cause a depositor panic in the case that the commercial real estate market buckles up? Yes, because what happens then? An article here from Yahoo Finance, commercial real estate is in trouble. A banking crisis will make it worse. Here we have an interesting paragraph. More than 80% of all commercial real estate loans are now held by banks with fewer than $250 billion in assets, according to a report by Goldman Sachs economists Manuel Abecassis and David Miracle. These loans now comprise the highest percentage of industry loan portfolios in 13 years, according to John Velas of Bank New York Mellon. And here is Goldman Sachs commenting on this. When the Federal Reserve hits the brakes, something goes through the windshield.
Oh, Mom! I think I pulled my groin!
George Gatch said at the $2.5 trillion asset managers European Media Summit on Tuesday. And here's from an article from Reuters. This lovely quote: banks will be primarily exposed to commercial real estate through bank loans on the balance sheet, she said. The total exposure of the U.S. banking system to commercial real estate loans was $2.5 trillion at the end of December, Fitch said. Now, if the entire exposure of the banking system to commercial real estate loans is $2.5 trillion, don't you think that that knocks something else in a domino of some other thing that maybe not every regulator has considered? I mean, it's $2.5 trillion of loan exposure in the banking system. That's quite a lot. Maybe something else goes wrong that they're not quite thinking about. And what happens to Deutsche Bank in that scenario? Well, look at this from Deutsche Bank, a $46 trillion derivative book. This is a table of Deutsche Bank's derivative book. These numbers are in millions. So if you have 15,003,362, it means 15 trillion, 3,362 million. So if you go all the way down to the totals here, you have this number, 42,527,190,000,000 of derivatives. Now, what does this mean? It doesn't mean that they have to have $42 trillion in their balance sheet. This stuff is canceled out on both sides, hedged almost 100%. You have a contract long on one side, then you have a contract short on the other side because you're a market maker. You're buying to one, selling to another with the same amounts of stuff. So this stuff is booked off balance sheet. It's not considered part of the actual capital. But then what happens when this thing falls? Well, if you go into the categories here, the derivatives, let's say that somebody wants to hedge interest rates because they have a loan and they have a floating rate loan. They want to make it fixed. So they hedge that with a derivative, and then Deutsche takes the other side, and then somebody else hedges the other way, and then Deutsche Bank makes that market and links the two. So you have $32.8 trillion of notional exposure here to the interest rate related derivative space. Now, what happens if Deutsche Bank falls? Well, then all the derivative positions that it has have to be liquidated. And when they have to be liquidated, whoever's on the other side of all those trades, they have to be liquidated too. And then people like sort of say in an infantile sort of way, well, if there's one trade on one side and the other trade on the other side, well, then they just cancel each other out, and you can just put these numbers back to zero or close to it, or the two banks settle on the difference of the notional amounts on the long and short side. But it's not that simple because the positions have to close on both sides. And when they do, that disturbs other derivative contracts because the open interest in that market falls, and that sort of wobbles every other derivative contract in the space. So you can't just close out $42 trillion of notional derivatives and expect there's not going to be any side effects. And so what we have here is a bank that has an adequate amount of capital adequacy, or whatever the regulators call it, to sneak into the post-2008 regulatory framework. But does that mean that the bank is healthy? Does that mean that there's not going to be a depositor run? Does that mean it's not going to fall? It doesn't mean any of that, because regulators are always fighting the last financial crisis, and they don't know what the current financial crisis is even going to be, because if they did, it wouldn't happen. Is Deutsche Bank going to be the next GSIB to fall? Maybe, maybe not, but it doesn't matter because something else is going to fall. You have a 5.5, was it $trillion commercial real estate market that is 80% held on the balance sheets of regional banks, which are now in collapse. What do you think happens then? Is that everything's contained, nothing else happens? Well, of course, the explosion continues, and the Fed is responsible for all this because it raised interest rates trying to contain consumer price inflation, because it printed $5 trillion in 2020 and 2021 because they wanted to finance everybody being locked in their houses. This is all fundamentally insane, being led by people who have no idea what they're doing, and it's going to lead to financial Armageddon one way or another. If you look back at the 2007-2008 era, the bank stocks started to contract and crash way before the general market crash of September 2008. You had Morgan Stanley, then you had Bear Stearns, then you had Lehman, and then only after Lehman did you have the general stock market crash, what we all remember. Before that, you had what's happening now, and it wasn't stopped, and it's not going to be stopped, because the Fed is not going to go back to zero until and unless we are in a full-blown crisis. And once it does, gold and silver will go to the moon. Where's the moon? I don't know where the moon is, but it's not on this planet.
Can I do the countdown? Huh? Oh, sure. Knock yourself out. 10, 9. Okay, we're here.
We're whalers on the moon.
We carry a harpoon.
But there ain't no whale, so we tell tall tales and sing our whaling tune.
We're whalers. That's not how it happened.
And as the financial pyramid built up since 1933 collapses, the only thing that will be left on it is the base upon which all of these derivatives, every single one of them, is based. And that is on gold and silver. And even though I'm editing this in now and it's a day later, if you want your supply of gold and silver, call Miles Franklin at 855-GAME-END, or go to milesfranklin.com and tell them that Rafi sent you from the Endgame Investor, and tell them,
Shut up and take my money.
But seriously, Miles Franklin is good. See the link in the description below. So get back to basics. Get back to the base of the pyramid. Get back to real money, and you should be protected, more or less, from the earthquake that is coming. This is Rafi of the Endgame Investor. If you appreciated this video, then sign up for a 2-week free trial of the Endgame Investor, or become my patron on Patreon, where I give out a weekly video of biblical commentary on monetary policy, economic topics, and government. This coming week, I think we're going to discuss the number 3. Not sure why, but I have a hunch that I'm going to be talking about it.